is human life value strictly related to the bills, or is it related to what your life means to the family in terms of the broader picture?
Your reason for insurance changes so much over time. I've met with clients over a 10-year period or an 8-year period, their reason for insurance has changed.
Focus on life. That means focusing on taking care of issues in life and then focusing on living life. So, welcome back to Focus on Life with Chris Curran and Keith Scotti. This is a podcast about living your best life, living your authentic life without financial worry. So, to start off, maybe why don't we just talk about our life? What did you do this weekend, Keith?
Yeah. So, this weekend, Saturday, played golf. Living in New Jersey, the weather's is starting to get worse and worse, colder and colder. You really can't play out as much anymore.
Well, you can't play anyway, so it doesn't really matter.
Well, actually,
you're using weather as an excuse.
Yeah, the missus got me some new irons, so I think
okay.
I've gotten better. Shout out to Tacoma. Not a plug, not getting paid by them, but if they see this and they'd like to, I'm in.
Well, you know the old saying, right? It's not the club, it's the swing.
No, it was the club. I feel like I played better. I played better.
Good. All right.
So,
way to go, Tacoma.
Yeah,
right.
played a municipal course here in New Jersey. It was good. I had a great time. I felt like I was striking them really good. And and then we went to a new restaurant out in Red Bank. It just opened up. It was like their soft opening. So just check that out and try out new apps, new drinks.
All right, so living a good life. So it was a good life this weekend.
Yeah, yourself?
Yeah. Same. Yeah, no, we had a good weekend. We went to see Sting perform at the Borgata in Atlantic City. So Sting is someone you probably don't know very well because it's my generation, but
I feel like I can name a few songs.
Yeah, no, he was with the Police. He did Roxanne and Message in a Bottle, those kind of songs.
Okay.
But yeah, great show. He's super talented and 74 years old, by the way. He looks better than I do. I won't tell you my age. But anyway, it was a great time, good show. We went with a couple of friends and had a great dinner there as well, and just a dinner party at a friend's house last night. So yeah, so all in all, a good weekend, living life. So
good. And
part of that makes these weekends, I guess, better for us is that we have addressed a lot of the financial issues in our life, so we don't go through these weekends and the events aren't tainted with this little worry in the back of our minds about, hey, am I going to be okay if this happens or whatever? And so today we're going to talk about life insurance and how to remove that worry about unexpected events happening, the worst events happening, so that you can go on and live your best life. So we're going to talk very basically about what life insurance is, what it does, and give you the kind of the no BS breakdown of what different types of insurance are. So
yeah, and I think for those of you that have been following us through the first couple of episodes, we talked a lot about social media content and things being contradicted and seeing one person saying this and saying the other. I'm very analytical to some extent. Anytime I make decisions, I create Venn diagrams or I do like a pros and cons list, and I kind of want to make sure, does this make sense for me? Do the pros outweigh the cons? And it needs to make sense, and you need to be well educated on this space. So I think we're going to go through the ins and outs of it, what types of products are out there, which one makes more sense for your situation, and which one seems more appealing to you. And also, I mean, there's a lot of things that come into it. There's budget, there's end goals, there's short-term goals, there's a lot.
All right, so we'll jump in. And by the way, I hope you're not spending your weekends doing Venn diagrams.
No. Sometimes.
All right, I have to talk to Molly if that's the case. So. But I get it. The complexity and abundance of information out there can cause you to kind of overanalyze, right? We talked about that. I think one of our last episodes is that analysis paralysis. So today we're going to break it down so you can get past that part of it and really just start to move forward with decisions on what to do. So you can put that aside and go live life without that worry. So what do you think? Where should we start?
We should start with what's the purpose? Why would someone buy life insurance? Like, let's start with the obvious. It's you dying and replacing income. I think that's where a lot of people, pretty much the standard on buying insurance is making sure that if I pass away in my situation, Molly can continue the same lifestyle that she has. She can pay off the house, whatever. That's another one, paying off the mortgage.
My opinion, it's income replacement, like you said. I mean, a lot of people think they start adding up, hey, I want the house paid off, I need money for college, debt's paid off. But for me, it's more income replacement because you could do all of those things. You could have all of those things paid off, but life doesn't stop. Bills keep coming, right? So if you're thinking, hey, I want my family left in a good position, it's not just having no debt. It's having income, right? That's how we live our lives. Income streams. So to me, life insurance is income replacement.
Yeah.
And essentially what you're doing with life insurance is you are buying time. Right? You're buying time from the insurance company. Sounds kind of weird, but essentially you're saying, all right, I expect to live until my kids are older and independent, we get to retirement, and I have enough time to accumulate the resources I need so that everybody is okay. But if I don't have enough time to accumulate all those resources, what happens? All right, and that's where the insurance company says, well, we'll give you the time, meaning we'll instantly fill the bucket if you run out of time.
Yeah.
Right? So that's essentially what you're doing in the most basic form. Now, there's many other uses of it, and we can get into, should you temporarily buy that time or lease it from the insurance company, or should you own it? Should you buy it outright, which is the difference between term insurance and permanent insurance?
Yeah, when do you feel like is the most pivotal time to actually make this decision? Is it when you purchase your first home? Is it when you have a child? Is it when you have shared financial responsibility with your loved one? Like, when's the key time that someone should take this into consideration?
Well, it's all of those things. So there's no key time. It's multiple times throughout your life. So I forget the statistic. It's from LIMRA, which is an insurance association, does all these studies. They say that the average person buys life insurance 7 times throughout their life.
7.
And that's because you have different life events that happen, right? Maybe you're getting married, you're having kids, you're buying a house, you've started a business, and you have a partner in business, and you have to insure that. Maybe you get later in life and you realize, all right, I need more insurance because I'm making more income now. So you buy more insurance. So there's different reasons. It's not a one and done type of situation. So unfortunately, a lot of people want that kind of black and white answer on, all right, how much insurance do I need? When do I buy it? And I'm done. Right?
Yeah.
It is kind of a moving process that happens throughout your life, but it doesn't have to be that complicated.
Yeah, and that kind of goes into the theory of human life value, and that term gets kind of loosely thrown around. And what does that mean? And what is my life value?
Are you asking me?
No, I don't even know. You might know, but I
that's
feel
a relative term for everybody. Yeah.
I think, like you said, like I've honestly been in this industry for a couple of years now, and I've already purchased it 3 times, and that's just my income continues to grow. And I think to myself, all right, I had, 5 to 10 years worth of my salary replaced. And then now my income continues to rise. Like now I give Molly 3.5 years to figure it out. Yeah. Like now I need to continue to bridge that and get that larger and larger. And we haven't had a child yet, but when we have a child, that's a whole nother mouth to feed. That's a whole other person to be responsible for. And that's going to grow more.
Yeah. So here's a good question. I don't know. We might have covered this in a previous podcast, but then the question is, all right, well, there's another mouth to feed. We have bills to pay. So is human life value strictly related to the bills, or is it related to what your life means to the family in terms of the broader picture? Meaning, and I guess where I'm going with this is, I look at insurance as a way to ensure that all of our dreams, me and my wife and the kids, what the dreams that I have for our life happen whether I'm there or not. Because if I'm gone, well, let me ask you the question. If you're gone, what do you want for Molly? And let's say you have a couple of kids. What would you want? Would you want less for them just because you're gone?
No, or I want them to have this if I was still there. So rather than human life value, we'll call it human dream value.
Yeah, that's a good idea. Yeah. So what are your dreams?
Slogan here.
Yeah. Let me figure out what the value of my dreams are for my family, and that's the amount of insurance you need to have. So,
yeah, I think that's good.
We just talked about your dream value, right? Human dream value. But honestly, human life value is how a lot of insurance companies look at applications when they come in. How much can this person be insured for? Because you can't just go out and buy an unlimited amount of insurance. An insurance company, the underwriters at that insurance company are going to determine whether it's an appropriate amount for you to have, right? And honestly, most people are woefully underinsured because when you think of it as income replacement, which is what normally happens, right? For example, in a wrongful death lawsuit, right, the courts will decide how much does a widow or widower get if their spouse was wrongfully murdered or killed. Yeah. I mean, it's always some kind of crazy bus or Pepsi truck that's running all these people over. But so if that were to happen,
don't sue us, Pepsi.
Yeah, forget I said Pepsi. And bus driver unions.
Yeah, seriously.
But that's always the analogy that's used. But so if someone dies wrongfully, the courts will decide how much was that person's life worth. It sounds kind of jaded, but that's how they do do it, and how do they calculate?
So you're
that?
thinking like the attorneys are like looking at that, and that's how do they come up with that random number of what they're quote unquote suing the person on a wrongful death? Yeah. I mean, same thing. I would say that a 35-year-old, they obviously typical retirement age is 60 years old. So they're looking between 35 and 60 years old, how much income that person had. And then they have what you said, pain and suffering. Pain and suffering.
They throw in some pain and suffering maybe. But essentially what they're doing is they're saying how many years of earning at what earning level has gone away for this family. And that's what they replace. So insurance company underwriters look at it in a similar fashion. They say, okay, well, what was the value of this person to the family financially? Obviously, you can't put a value sentimentally to the family, but they'll do that for financial reasons. So then the question becomes, all right, well, how do we put that coverage in place? There's different ways to do that, right? You can have term insurance, you can have permanent insurance, you can.
Well, let's break those down. So, and I think a lot of listeners that are in this space, or maybe they've already purchased, or they're looking to purchase, or maybe they're looking just in general because they have a new business partner, whatever the case is. Term insurance is just flat out pure coverage, right? So it is the most cost effective, but when we talk that Venn diagram, me going into my crazy analytical pros and cons, the pro of term insurance is I'm renting it. I don't own the insurance. So I'm paying a smaller premium, or when premium for us is what you pay out of your bank account into a policy. And then in return, the insurance company is going to give you that coverage for that period of time. Periods of time can be in different formats. It could be a 10-year period. It could be a 15-year period. It could be a 20. It could be a 30.
So what you're saying is during that term that you choose, the cost is laid out. It's guaranteed. Right?
Yeah,
at the
premium.
At the end of that term, you have to renegotiate with the insurance company, and your costs go up. So that's the thought process when you're using term insurance is how long do I really need this insurance for? And I want to pay as little as possible for as much coverage as I can get. That's term insurance.
And then let's kind of tie that into when people purchase insurance and the appropriate time to purchase it. So traditionally, 30-year mortgage, which I know floating around nowadays is a 50-year mortgage, and I don't know if that's going to happen or not. But traditional 30-year mortgage is what people typically get when they purchase their first home. If you bought $1 million home, and in some people's eyes, not being educated, just saying, I want to make sure the house is paid off, they may get to buy a 30-year term policy. So that this way, if they pass away, the completion of the purchase of that home is completed. Now, maybe a 20-year term is appropriate for when a baby's born. And you want to make sure.
A good point. I do a lot in the college planning space. So what I often find out when I'm sitting with a parent whose child is going off to college or getting close to college is I say, are your coverages updated? Right, because they're going to need you alive during the college years and maybe for a few years after or to get to retirement. And a lot of people will do that. They'll buy a 20-year term policy when the child is born thinking, all right, when they're 20, I'm okay. But then all of a sudden they realize, you know what, I'm going to need it for a little longer than I thought. And they have to re-up at the end of that 20 years right when their kids are in the college years. So that's a thought process there. Might be when they're born, a 30-year policy might be better to get through those years if that's what you're thinking. That's what it is. It's just pure coverage. You're saying, I want the most coverage for the least amount of premium. And at the end of that term, I don't feel like I'll need the coverage anymore. So that's when you take term insurance. And like you said, for mortgages, years ago, it's not as popular anymore, but they had mortgage insurance, right? Most people confuse the terms, but mortgage insurance is life insurance. When you take out a mortgage,
or
you
mortgage protection.
Mortgage protection, right? It's life insurance. That's all it is. And you'll get letters once you take out a mortgage or buy a new home. You'll get inundated with letters from companies saying, have you put in place your mortgage protection? And you think like it's something mandatory like car insurance that you have to do, but it's not. It's just them saying, hey, if you want your mortgage paid off, if you die early, you need life insurance. But they used to set it up so that the amount of coverage would decline along with your mortgage balance over time. Mm-hmm. So you're not paying for as much insurance. It sounds like it makes sense, but that's kind of gone by the wayside because people realize that the mortgage is just one thing. They need coverage for other things if they're gone.
But it's also appropriate to have that because I think realistically, if you didn't have this mortgage protection, and the breadwinner or someone that is helping financially with the mortgage, if they pass away, the bank's not going to come to you and say, so sorry for your loss. We're going to cut your mortgage in half. They're still going to get paid. They still want the payment. And if you don't make the payment,
well, they take the house. Yeah, that's foreclosure.
You going to see Sting on the weekends is gone.
That's over. Well, Jill won't be able to go. I'll be gone.
Oh, you'll be gone.
I'm not seeing Sting at all. So when it comes to mortgages again, do you want your survivor to have the income or the money to continue to pay the mortgage, or do you want want them to have enough to pay the mortgage off. People will feel differently about that, right? If your spouse has a 2% mortgage and that money that comes to them from the life insurance company could sit in an account earning 5%, maybe you wouldn't want them to pay the mortgage off. If the mortgage is really high, or if the mortgage is just a source of complication in their life that they just don't want to deal with at that time, then yeah, go ahead and pay the mortgage off. But it's not mortgage insurance or life insurance to pay the mortgage doesn't always have to be used that way.
No, it's 100% true. I mean, very similar situation I was in, and a lot of people, for the viewer that's listening to this, if you feel this way, that's okay. Everyone's always on this like, I need to pay my mortgage off. Like that's freedom, that's the American dream. I own my home. But with the benefits of having a mortgage, of writing off all the interest on your taxes, with having a low interest rate in this time frame, it's not that low, but it can get lower and lower. But ideally, let's say we were 10 years removed and we were, where interest rates were a lot lower, it does make sense to take those assets and just continue to grow them rather than pay off a mortgage.
Yeah,
and have
there are a lot of people out there still with very low mortgage rates from previous to COVID. 2.5%, 3.5%. Might not make sense to pay the mortgage off. So you want to have that option instead of having mortgage protection that's where the beneficiary on that life insurance is the mortgage company. Just have your own personal life insurance. Let that money come to your survivors and let them decide whether it makes sense to pay the mortgage off or just put it in an account, earning more interest, and they continue to pay the mortgage, get the tax deductions.
Yeah, and that's why it shouldn't be intimidating to sit down with somebody, because this isn't things that you're acclimated with every day.
Right.
People that are police officers, they're not thinking about, their mortgage. I mean, they're thinking about their family, obviously, when they go out on the job, but they're not thinking about finances. They're just thinking about going out, being safe, and coming home. Like my dad was a cop for 20 years, and he always said, he was like, I want to make sure that I make it home every night. That was always his thought. Don't be intimidated to sit down with a financial professional and kind of get an understanding on what's the best strategy, because every strategy is different for every person. There's not one cookie cutter plan. And that kind of leads right into permanent insurance and what is that, and does that make sense for my financial realm or my portfolio, because there's all different reasons on why permanent insurance is good or bad. It just depends, but let's talk about permanent insurance and what does it mean and how does it work.
Okay. Yeah. So like most financial issues, it's not black and white. People want the definite answers. Again, should I lease a car, buy a car? Should I have term insurance, permanent insurance? And there's very polarized opinions on both sides in the financial world. We take the approach that, look, every situation is different, and you have to make that decision based on your specific circumstances, not on some stated rule of thumb given by some financial guru that doesn't know your particulars. So when breaking it down, it might be that you're using a combination of both of those for different reasons, right? Maybe you need a lot of coverage while your kids are very young and you have a lot of expenses and you're growing your net worth and you can't afford to own all of that as permanent. So you buy term insurance. You have a lot of term insurance, and then maybe you start kind of putting into that portfolio some permanent, and you can convert that term insurance over to permanent along the way if you want to. Or you might decide, all right, as long as I get to X age, I should be good, and I can let the term fall away and either have no insurance or have a portion of it be permanent that I can take it to retirement for other things I might want. So the difference between the two is essentially leasing versus buying, right? So with term insurance, you're saying to the insurance company, I'll pay you what I need to basically live in that house, that term insurance house, for 20 years. And at the end of those 20 years, you own the house. You own the house the whole time. I'm just paying you rent to stay there. At the end of that 20 years, I've got to renegotiate or go somewhere else. With permanent insurance, you're saying, hey, I want to own that house. I want to live in that house. I want to have the option of living in that house forever and not having to move out at the end of the 20 years. So I'm going to pay I'm going to pay more to start building equity in that house. I won't own it outright, but very much like a mortgage, I'll pay a premium and I'll build equity. And at the end of the 20-year term or 30-year term, whatever it is, I now own the insurance, or I own that house, and I can decide what I want to do. If I feel like I don't need that house anymore, I can sell it and cash in and take the money back. Same thing with permanent life insurance. If I don't need it anymore and I want to just cash out, you can do that. If I decide, hey, I still want to stay in this house and I want to stay in here forever, then great. Maybe I don't need to pay the mortgage anymore. I've paid enough in and I own it and I can stay here forever. Or a third option is maybe I want to take some of that equity that I built up in this and do something, but I'm going to keep some of the house, right? Or maybe a smaller portion of the house. That's how I think of life insurance, permanent life insurance.
Yeah. And I think what a lot of the viewers don't know or understand, or listeners, is the appropriate time to buy and what goes into looking into what's the appropriate thing to do. And then going back to the Venn diagram, the pros and cons list, typically with any insurance, the younger you are, the healthier you are. When the insurance looks at you, right, they're looking at what's the likelihood this person's going to live a certain period of time.
Yeah.
Right. And I even with clients, I use this all the time. And have you seen Along Came Polly?
Yes.
All right.
Yeah.
So, and if you guys never seen it, it's Ben Stiller, and it's kind of like a love story, but his job.
Who was the
Jennifer Aniston.
Yeah.
But he's an analytical person, and he's like, they're at the bar, and there's the peanuts there. He doesn't want to eat out of the peanuts because, everyone else puts their statistics show.
Germs,
People don't clean their hands up the bathroom, whatever. He follows around a gentleman that they're looking to insure, and he's base jumping off buildings, and he's skydiving, and he's doing all dangerous things that in an insurance company's eyes is dangerous, and it's a higher risk.
Yeah.
So when you apply for these contracts or insurance policies, they're looking at your age, they're looking at your overall health, and they're determining on mortality factor. What's the likelihood that you're going to survive a certain period of time, and that's how they insure you.
And that's where the lifestyle comes in too. If you're a base jumping, what was that scene where the guy's got a base jumping, luge jumping?
Wait, where's that, bro?
In the scene in the movie where he sends his buddy into the conference for him.
Oh yes, I know it's
the actor who
he didn't want to pass away.
But
Philip Seymour Hoffman.
It's one of the best scenes I've ever seen in the movie. He's funny. So he's pretending to be the underwriter.
Yeah.
So what are we really talking about here? Are we gonna insure this guy? Are we gonna insure this base jumping crazy mother effer?
Or will this base jumping, crocodile wrestling, volcano luging, snake wrangling, motocross racing
But that's what they do. Underwriters are tasked with the idea of making sure that they take on good risks, right? Because if they just insured everybody without looking at the risk factor, insurance companies would go out of business. So what they're saying is, all right, tell us about your medical past, your medical history. Most of it is all big data now. Most people don't realize you don't have to go get examined. You don't have to give blood, or urine specimens, and all that stuff to get insured, because most of all your medical data, prescriptions, all that stuff is out there on databases.
Yeah, it's digital. I mean, I talked about that with the doctor's office, not to cut you off, but when you used to go to the doctor's office as a kid, you walk up to the window, they slide the thing across, and behind them there would be bookcases of things, A, B, C, manila folders all inside of it. Now you go to the doctor's office, that doesn't exist. There, it's not there anymore. It's because all of that digital stuff is digital now. Yeah. And
so insurance companies have taken advantage of that and can literally give an underwriting answer within days, sometimes minutes, by just pulling up data and coming up with some kind of score, like almost like a credit score, based on, do you have a criminal record, DUIs, what's your occupation, is it high risk, what prescriptions have you taken in the past, have you had surgery? So they put all that, it comes up with this answer and a risk rating, and that's how the insurance company decides how much your premium is. So my premium is definitely going to be more than your premium because I'm older.
Right.
So I'm more likely to pass away sooner. So they've got to collect more money from me to make sure that they can still cover me and make a profit. So they take all of these premiums, they pool it. So that's what we're doing. We're pooling risk. And the insurance companies know, well, some people are going to die sooner and some people are going to live longer than expected. But we have it all figured out. Actuarial science. We know exactly how much we have to collect from different people. We know how many people are going to die every year. We just don't know which ones. Mm-hmm. So we put that all in a pot. We invest it, we earn money, we charge premiums, and we pay out claims based on all this math that we put together. So that's essentially what underwriting does. And so one of the things I think where you were going with that is, when is the right time to buy insurance? Obviously, the younger and healthier you are, the less you're going to pay for that insurance. You could lock it in at a lower rate because the insurance company knows they have likely more time to collect that premium because you're young and healthy.
Yeah, for sure. And there's no guarantee in anything. You got to make sure that whatever plan you decide to go with, you make sure that it makes sense financially for yourself and it aligns with your human dream value.
Yeah, I like that, human dream value. In a perfect world, you could say, all right, here's how much money my family would need if I'm gone to do all the things we want to do. And let's say it's $3 million, right? Which is not a high amount. that's maybe sounds like a lot, but when you think about how much income you'll earn between now and the time you retire and all the money you want to spend, the things you want to spend that money on, it's not a lot. So say it's $3 million. So ideally you'd say, all right, well, I'm young and healthy. I want $3 million and I want to own it because I want to have the choice down the road of either keeping it or cashing it in or just dropping it altogether. But that requires a high level of premium. It's the same thing again. I'll use the house analogy. Well, yeah, ideally I want to live in a $3 million mansion. Well, today, if I wanted to go out and have that $3 million mansion, I've got to come up with a lot of money. I don't have to come up with all of it, but I got to come up with enough for a down payment and to pay a mortgage payment on that. So this is very similar to permanent life insurance. I want to have a big chunk of it that I own and can decide what to do with it later. I want to build equity in it so that I can cash out later if I want to, or just leave a bigger legacy. So to own that right now, I have to come up with a bigger chunk of money, a bigger monthly mortgage payment essentially to do that. And if I don't have it, that's okay. That's what term insurance is for.
Yeah.
Because now the insurance, so I'm not buying the house, I'm just going to rent it for a while and then you move forward that way. We've talked about term insurance and permanent insurance and what they are and the whole kind of general idea of what insurance is. Let's focus more now on the different types of permanent insurance, because that can be very confusing to people. And let's break it down so that they're not looking at 50 different options.
Okay, so let's start with the obvious one that most people are under the impression what permanent insurance is, which is whole life. Whole life insurance, what does it mean and how does it work? Ideally, I don't want to say it's the most expensive, but the premium cost is higher, and that's because it works in a guarantee factor. It's kind of like what you said is the CD of insurance.
Yeah, and if you're making the analogy of the banking world, a CD or the investment world, CDs are steady, right? You get a set rate of return, and you don't have to worry about losing money. Right. But what do you give up? Anytime you have certainty, you're giving up potential growth, right? More growth. With the three basic types of permanent insurance, they're on a spectrum, right? I mean, there's probably 50 different variations of these three different types of insurance, but essentially they all are just that. They're just variations of either whole life, indexed universal life, or variable universal life. Those are the three main types of permanent insurance. And as you just described, whole life is on the very certain end of that spectrum.
Safest
Side, right? Meaning you have guaranteed cash values as long as you pay the premium, plus you're going to get some dividends, very conservative dividend payouts. So every year you're going to get some kind of return on your equity in that policy while you're being covered. On the other end of the spectrum is variable universal life, and that's where you're kind of assuming more of the risk of the cash value. You have the protection, but you're telling the insurance company, hey, I want to get more upside than a whole life gives me. I'm going to take some risk with my cash value and invest it in the markets, right? And usually it's a kind of a basket of mutual funds inside the policy that you can choose from. So you can have more growth, but you can also lose that money if the market goes negative.
And even worse, you could lose the insurance if the cash expires.
Yeah, so you've got to be very careful with variable universal life. We don't use it very often. In fact, I don't remember the last time in years I've sold one. But it can benefit you if you really just want more growth. But essentially, I don't like to mix insurance with growth aspirations, right?
Yeah, and this is where, and I'm cutting you off a lot, I apologize, but this is where you get all those, if you're in the market and you're searching for insurance or you're looking at, you're getting acclimated with like, stop,
right.
Don't, to make sure it's structured properly and make sure, like, what do they mean by that? And what is that? Like, I don't understand that.
Yeah. So when you see those Instagram reels or shorts where, hey, if you just bought an IUL, stop right there or don't buy an IUL without talking to us or reading this report. And those are just a lot of scare tactics, and it's just designed to get you to click and buy insurance from that person, right? Depending on which product they're pushing. But you do have to be careful with variable universal life because you have to realize that you're taking the risk on, right? So if you're insuring your family and at the same time injecting risk into that by saying, well, the cash value in that plan, I want to grow based on the market, you can run into trouble if the markets don't perform the way you expected or the way they're illustrated sometimes, right? Because nothing goes in a straight line when you're talking about markets. But that's basically how they're illustrated. You're going to get an average rate of return. But what if you get big negative years at certain points in the policy? It could affect the lifespan of that policy. So we don't normally use variable universal life because when you're talking about life insurance, you're trying to de-risk your life, right? Not add more risk to it. The kind of hybrid in the middle of that spectrum is indexed universal life, which carries some of the certainty and protections of the whole life, but not the risk of variable universal life. And basically what that is, it's saying, I want the coverage. I'm going to pay premium that allows me to build equity in this coverage. but I don't want that equity at too much risk. I want to have the chance to earn more than I would in a whole life, but I don't want the downside risk. So what you normally have there are floors on the downside where you can't lose money in a downward market. But in order to get that, there's always a trade-off, right? There's never a free lunch. So in order to have that protection on the downside, what do you have to give up? You have to give the upside potential. But you don't have to give it up completely. Indexing will say, well, if the markets are doing well, you're going to share in that return at a certain level. You're just not going to get all of it because we need to hold some back to protect the downside. So it's a way to potentially earn more, get more growth than you would, say, in a certain product like a whole life, but you have to give up something to get that.
Kind of like the happy medium, the hybrid.
Yeah, we use that predominantly when we're talking about someone who wants long-term protection and wants to accumulate some equity in it as well. But every situation is different. Some people don't like the idea of not getting some return every single year, and that's where whole life makes a lot of sense. You have guarantees and certainty. Some people want that. They like the risk. They like the ups and downs in the market. So they might prefer VUL, or variable universal life. Indexed is that kind of nice middle ground, in my opinion. And you can. Again, I said earlier, when you're talking about insurance, you're trying to de-risk your life, and I separate protection and investment. But that doesn't mean you can't use policies very effectively to build wealth too. Right, building it just like a house, right? We don't buy a house thinking that, well, let's see, maybe the rate of return on this house is going to really exceed my expectations, right?
Yeah.
We just figure a house is going to grow at 3 or 5% rate over time. Real estate's going to grow, and I'm going to build equity in that. That's how I look at insurance. I use that analogy with the house often because, again, people, unless you're flipping homes or doing it in a speculative way, most people are not buying homes as an investment. They're just looking at it long term. I can build wealth here in a steady way.
Yep. After talking about all these different options and different types of permanent insurance, I feel like your reason for insurance or your reason for life insurance has changes so much over time. And all the cash inside of it or the death benefit that's inside of it, do I still have a need for it? And I've met with clients where and it's over a 10-year period or an 8-year period, their reason for insurance has changed. Originally, it was the purchase of the home. Then it was making sure that their loved ones are taken care of. Then it's grandchildren come into the picture and you want to leave a legacy. So how do we utilize the death benefit to the best potential as well as all of the cash value that's inside of it? What if I don't have a need for the death benefit anymore and I just have all this cash inside of the plan? What's the use with it? So
that's a common question, right? We talked about how if you're going to own insurance, permanent insurance at the end of that term, whatever it is in your mind of retirement, maybe you feel like you don't need the insurance anymore. You have options now because you have all this equity built up. You could keep it and treat it as legacy money to your heirs and then spend all of your other money freely, kind of almost like a permission slip to spend all your money because you know when you die that insurance is going to come in. Or you could cash it out and take that money and do something else with it. But a lot of people think, well, I don't want to wait that long. What if I want to use this money sooner? You know how a lot of people, again, I keep going back to this home analogy, this mortgage analogy. A lot of people will build up equity in their home over time and then go in and use that during their lifetime by taking a home equity line of credit or cash out refinance to take money and do things like pay for college or buy another house or whatever they need it for. It could be debt consolidation. So you can do the same thing with permanent insurance. Is you don't have to wait necessarily until the end of whatever time period you thought you needed the coverage. As you're building equity, you could access that equity and use it for different things. Matter of fact, there's a lot of advantages to using that versus traditional lending sources. So we do that a lot in the college planning space for paying for tuition bills, as opposed to taking student loans out. Maybe you take equity out of your policies to pay for college.
So a little more of a liquidity asset rather than utilizing your retirement assets or utilizing your home value to
it's certainly more flexible.
It's a collateral.
I look at a lot of policies that I set up for myself and my clients as almost like cash reserve accounts that can be accessed along the way. They're not as restricted, say, as money sitting in a 401k that you can't touch until later on, or home equity that you have to go to a bank to and apply for, right? Equity in your insurance policy you can use at will for whatever purpose you want. So that can be an effective way to look at it along the way. It's not just something you're setting up, like we talked about earlier, setting up and forgetting about it for the next 30 years. In fact, I know you recommend annual reviews all the time with your clients where you're looking at your portfolio and making adjustments because your life changes along the way. Right?
Yeah, your reason for insurance changes. It's so often, and me already purchasing 3 different times in my life because of my income has increased over time. I'm going to be purchasing a home soon. Molly and I are going to be having kids soon. So those are all things that I'm going to have to continuously revisit. And if I don't revisit them and I just kind of have that worry in the back of my mind, I'm like, you know what, I have it, I'm good. Yeah, that's okay. But what happens when the inevitable happens and then you're like, well, I didn't get set up appropriately, or I don't have the right plan put in place. So it's always good, and I encourage you, if you already have a plan put in place, to have some sort of professional review it. Obviously, we could review it for you, but I mean, either way, we're here to give the education and give some purpose and shed some light on the pros and cons of everything, so you have a better understanding.
Again, because people don't like to waste time thinking about this stuff, and they want to live life. But if you don't take care of it, are you really living your full life? Because it's something that's on your to-do list in the back of your mind. We talk about this all the time because it's the main theme of the podcast is focus on life. How do you do that? That means focusing on taking care of issues in life and then focusing on living life.
So to close out, this episode is really just giving you a good summary on the different types of insurance out there. There's term insurance, which you're basically what we use in the analogy of renting it rather than buying it. It's a more cost-effective way to protect yourself and your loved ones. And then there's also permanent insurance.
Yep.
Which is
and when you say cost-effective, meaning in the short term, can be very cost-effective because you're likely not to receive the benefit, right?
Right.
Most insurance companies will say, all right, if a 30-year-old buys a 20-year term, they're likely going to be alive at 50, so we don't have to charge very much to cover them.
Yeah.
So cost-effective in that way. If you're thinking longer term and you have designs on legacy for your family or wanting coverage into retirement or accumulation of wealth in another bucket, that's where permanent insurance might make more sense. So hopefully what we've talked about today clears that up a little, but the bottom line is you really have to sit down and decide what are you really trying to cover, what are your goals, what's your human dream value, right? And put it all together from there.
Yeah.